started. Thanks everybody for joining us today. We have a pretty tremendous panel. I'm very excited and honored to be sitting up here with the three of you. This is housing sustainability, navigating economic challenges for homeowners. And we have Eileen, too, right to my left here. She is the Vice President of Mortgage Product Development and Credit Policy for Rocket Mortgage. She leads a team that is responsible for managing the company's suite of mortgage product offerings and policy from origination through servicing. Over 32 years of experience, which is pretty amazing, and 2 decades of leadership within Rocket. And she serves as a member of the MBA's Affordable Housing Advisory Council and Fannie Mae's Affordable Housing Committee. And to the left of Eileen is David Batney. He's the Executive Vice President of Capital Markets for Guild Mortgage. He oversees the firm's capital market activities, including pricing, hedging, and secondary market execution. He's also responsible for Guild's credit policy, shipping, and product development functions. Used to work at Penny Mac, Fannie Mae, and First Interstate Bank of California. He's Vice Chair of the MBA's Residential Board of Governors and is a member of the MBA's Affordable Housing Advisory Committee. So welcome. And then last but not least, we have Giselle Roget, the founding principal of Overbrook Square Group, a Washington, D.C. based public affairs firm focused on the financial services and housing sectors. Since 2021, Overbrook has helped clients advance policies that empower individuals and communities to build wealth. For over 15 years, Giselle has held influential roles leading teams and directing policy in D.C. She currently serves on the Board of Governors for the Homeownership Council of America and the Board of Directors for Women in Housing and Finance, as well as the National Advisory Council and National Housing Conference. Whew, that is a lot. So we have a pretty tremendous amount of experience here between all of you, probably, I don't know, close to decades and decades. So I'm very excited for this panel. So why don't we jump right in and talk a little bit about what housing sustainability means. And often I think we've thought a lot about servicing and credit policy kind of in boxes, right? Like, okay, this is what's happening here. Homeowners get into a home. Oh, and then there's these other set of policies over here. But in thinking about and talking with you guys prior to the panel and just in discussions over the course of years, I think housing sustainability has other layers to it and other potential meanings. So how are we pursuing new homeownership today in ways that are more focused on sustainable, that is keeping borrowers in their homes and home ownership? What is our understanding of the nexus of sort of servicing with origination policies as it relates to sustainable home ownership? And Giselle, I'll start with you.
Well, great. Well, when we think about sustainability, there's a lot of different ways to conceive of the topic. There's some people that think of sustainability and a sustainable borrower outcome as just that borrower staying in their mortgage. You can think about it in the govy versus conforming space. Sustainability would be conceived as a borrower perhaps graduating from an FHA program into a non-government insured program. But I think that for the purposes of this conversation, when we're thinking about sustainability, we're thinking about a borrower outcome in which they do not lose their home to a foreclosure event and they're able to stay in their home. And so I think starting off from that initial framework, as we're thinking about sustainability, there are 2 things that are top of mind for me. And one is that sustainability and this whole conversation of sustainability starts with the mortgage at origination. And there's a couple of different items that kind of fall underneath that, largely the disclosures made to the borrower. And 2, as policymakers, as industry, we think about, and the way that we think about homeownership policy and the way that we think about the success of our homeownership programs needs to be tied to this question of sustainability, and specifically tied to it in how we measure the performance of our homeownership programs. So to that first item of sustainability and the sustainability question begins with the mortgage at origination, I really tee off on the disclosures made to the borrower. And I think that one of the positive impacts of Dodd-Frank, as well as some of the work that initiated with the Bush administration in terms of simplifying the RESPA and TILA disclosures and combining them on down to today, is borrowers do have a very good picture of what their mortgage expense cost is going to be, and that is key. We're not going to run into some of the so-called tricks and traps that Senator Warren warned about previously. But I think that one of the issues when it comes to disclosure and borrowers that we don't have a good handle on is the overall housing expense. And that's because there are two wild cards. And one of them we talked about earlier today, which was insurance and insurance policies and the premium prices going up there. And there really isn't any way to model that or prepare the borrower for that because every company sets rates differently. And the other item is taxes. And again, very local issue there. So I think there's great work that we've done with disclosures to borrowers, and that really prepares them for a sustainable journey as it pertains to the mortgage expense question, particularly for adjustable rate mortgages. But I think there's still some more stuff that we need to see how we can prepare borrowers with education. And then second, just broad topic of this question about sustainability. We just haven't done a good job, I think, as industry or on the regulatory side of actually measuring the success of our homeownership programs in concert with borrower sustainability and homeownership sustainability. It's been a goal, I think, for many, but it's always been a goal that's never really been a SMART goal. And that's something that I think going forward we need to take into consideration, because now more than ever, the mortgage at origination, because that's being sold to investors overwhelmingly, it's so key that original mortgage is going to be sustainable.
Yep, that's right. Really good points. Eileen, in your 32 plus years in this industry and 20 at Rocket in particular, how do you see sustainable homeownership and servicing kind of being a part of that? And what's changed? What's changed since you sort of started early on to sort of now in the space? And I'm sorry, I forgot to introduce myself. I'm Teresa Dumais, Vice President of Government Industry Relations at Freddie Mac.
Yeah, and I really like how you teed up that question. And I really think there is that ecosystem of, it's not just about in isolation, servicing and all the policies, and hopefully it all works. Servicing and loan performance informs origination. It informs origination programs and products. And so when you better understand that, what does and what doesn't work, that helps create the policy up front. It's like this wonderful ecosystem. And I think what's great is that, and we're lucky to be able to service and originate our loans, is that we can tie those performances together, and how can we ensure that people are put in homes that they can afford. I think that's the key, is that, and I think Sandra Thompson, I think everybody so far has been talking about, you want to put people in homes that they afford and can understand. It shouldn't be that you put them in a place where all of a sudden, after a few more months, they're in actually a worse position. And so we think about in origination, all of the guidelines, it's income, assets, credit, and the property, right? Those are all key factors to think about when you're thinking about, hey, what is it that drives success? What factors should we be looking at? And then ultimately, what doesn't work? And should we be a little more rigorous there? And so I think some of the challenges, though, and I think about back in the day, we've all actually been around forever and a day, is that something to consider is that our socioeconomic landscape looks different. I mean, we didn't have cell phones or anything back in, I don't know, 19 whatever, but yet that's not incorporated really into a DTI. Or if you think about income and gig economy, that was not a thing back in the day, where you think about, hey, I can just pick up a drive, I'm an Uber driver, and I can make ends meet by doing some of those things that just didn't exist. And so our policies need to morph with that, and understanding and recognizing those things as sources of financial income, whether it's debt. So again, with the outcome of being able to create sustainability.
Yeah, 100%.
Yeah.
David, any insights and additions?
I would just add to their two comments. One way we can maybe frame sustainability is the first 5 years of home ownership. And I think it's fair to say that a first-time home buyer really has a math problem during those first 5 years, which is they're in a very tight financial position. They just paid a lot of fees to close a loan, they put down a large down payment, and they have a very scary high monthly PITI payment. From a mathematical perspective, if they got a fixed rate loan, they are in probably the toughest financial position they'll be in. And as each year goes by and their income goes up, hopefully they have a fixed rate loan, so their housing costs stay flat and their income goes up over time. But the first 5 years, their ability to accumulate new savings each month between their monthly take-home pay and their mortgage will be the smallest they'll ever be in life. And whatever cash reserve is very possibly the smallest will be in life. So they're just mathematically in a financially tight position. And during those first 5 years, curveballs will happen. There could be changes to their income or changes to their expenses. And if we can help create a product that helps them survive those 5 years, then I think that product feature will tie into the servicing outcome. So we'll get the right sustainability or servicing outcome by having the right product features to begin with.
That's very true. So what I'm hearing all of you say is that the upfront products matter as part of sort of the servicing strategy, and you're looking at it all kind of holistically, and it makes a lot of sense, actually, Eileen, that you are, at Rocket overseeing all those pieces, right, to make sure they have linkages and connectivity, connective tissue, if you will, and that we're looking at a borrower's situation from sort of the beginning through what that waterfall could look like should they get into any kind of issues. So how can we start to help the industry wrap their arms around? I mean, I think it's understood in many pockets that these things need to go together. I just don't know if it's talked about, particularly in Washington, in that kind of way, right? It's like servicing policy, credit policy, but how do we start to sort of think about the pipeline for homeownership in a more holistic way? And David, I'll start with you this time.
So I think the pipeline should be holistic in terms of both product and how we service. And so, for example, we underwrite a loan and originate a loan or create the eligibility terms of a product. That's a big starting point. So we should correctly measure the person's residual take-home pay each month to know what their position will be in terms of ability to either have a cushion of cash for surprises or to accumulate savings. In terms of how we look at the borrowers for down payment, there's 3% down programs out there, and we've historically thought that that's very important because it creates emotional equity in the property. I think we should really look at that. Is it better to have 3 points of cash in a down payment, or could that 3 points of cash be in a reserve account for the borrower? And if you look at the VA world, where you have 0 down loans, they perform very well because they have residual income underwriting. And so are there things we can learn from the VA world that also could help drive having the right balance and combination of product features? Another fact is there is a strong correlation to the cash reserves a borrower has and what their default rate looks like in those first 5 years. So are there things we could do to create higher cash reserves that either sit in the borrower's savings account or other type of reserve structures that create a financial backstop during those first 5 years? And if you think about it, if you buy a house that's not a brand new house with brand new appliances, during those 5 years, there's a 50% chance your hot water heater will fail. 50% chance your refrigerator will fail. Those right there are 2 expenses that are $1,000 or higher, and the Federal Reserve's done studies that show 39% of all adults cannot absorb a $1,000 expense without resorting to bad financial alternatives, like going up on your credit cards, paying bills late. So it doesn't mean that a refrigerator will put you down into foreclosure, but it could put you into a very weak position. And then the next life curveball that could come your way could destabilize you. So if we can create a structure that can create reserves and help sort of absorb those sort of curveballs that occur, we can put the people in a better position and better have that holistic connection to the servicing quality.
That's right.
Yeah, and I would just add to what David shared about residual income and the VA model. You know, I think that in assessing the borrower's position for sustainability, thinking about their ongoing income is really important. And, you know, obviously the VA has their residual income test. In the FHA space and the GSE space, you know, I think that we're seeing some good headwinds in terms of taking into account income streams. So taking into account income streams from rental properties that are, you know, attached to the unit. So maybe, you know, an ADU that's attached to the unit. That was a novel policy that the GSEs and FHA introduced. And also we're seeing special purpose credit programs that lenders are using that are taking into account residual income. So I think that's one way to set up a borrower for success at the front end. And also, you know, we can think about, okay, so we have it in the VA program, we have it used by certain lenders for special purpose credit programs. Do we want to try to acknowledge this importance of income in underwriting, you know, across the board in a more universal way?
That's great. Eileen, how is Rocket thinking about this concept of sort of residual income or analyzing income, all, you know, the sort of pieces that David and Giselle just talked about?
Yeah, 100% agree with you that is an industry we need to think a little bit more about. It can be residual, you can call it net cash flows as well, right?
Yep.
As an underwriter, as a former underwriter, you think about, you can see everything in a bank statement. You really can. And when it comes to affordable housing, I would consider thinking about different cultures and the way they spend and the way they save can vary like across the board. But if you look at cash flows, which is similar, it's the same idea as residual, you can see how much savings somebody actually has at the end of the day. And that really is directly impactful to performance. And so I think as the GSEs they have that in their model, they have that in their, if you pick one of their affordable programs, that is a lever that you can pull. And I'd love to see that in some of the wider programs as well. And what I do love is we're saying is we need to challenge what we are doing today. What we've done before is not going to really necessarily create success in the future. And so the idea of down payment versus reserves, which we've started teeing off, which is better? And I think you might want to pose the question, but
I think you just did.
I just did.
It's true. Well, you know, what is that interplay, right?
That's right.
And we've just, you know, we hear a lot about, you know, the importance of down payment, and I think we just heard in another panel the sort of survey that you know, a lender did of first-time home buyers where they said down payment's the biggest, you know, barrier to home ownership.
Right.
Is it from your guys' perspective, or is it a little more nuanced than that? How should we be looking at kind of, you know, helping borrowers be sustainable, especially in those first 5 critical years, and thinking about it from this, okay, we're having more conversations about reserves and residual income, more and additional conversations about down payment, but how does that all sort of interplay, and how, especially you guys doing the lending, you know, when you're looking at a borrower and trying to determine their ability to repay and their ability to sort of be sustainable in a home, what does that look like for you guys?
For us, down payment is one of the largest barriers, and so one of the things that Rocket has done is offer this program called 1+. It's basically 1% down, and the idea is to say, you know what? Again, challenging the traditional. People think 20% down, but also 3% down, right? Is the next kind of step, 95% LTV or 97 LTV. But the challenge is really, should you be, instead of burdening the borrower up front by putting more down payment, or do you take that and create more reserves on the back end to exactly your point, which is save it for a rainy day, save it for the furnace that's going to blow, which I know that does literally happen within 5 years for some bizarre reason. And how can you afford that, right? And so there's been studies. I think Urban did a study, and it said that their 97 LTV programs with reserves versus like a Home Possible, Home Ready without reserves which one performed better, right? And so what they found is the ones with reserves, those programs are both 3% down, performed better. Fannie just did a reserve study, and what they found was that if you, there was no difference in the LTV. They found that performance improved 50% of the time if the assets were used for reserves instead of down payment. So I think that's enough to tell folks to say, you know what, we need to challenge ourselves from a program perspective of saying that skin in the game is most important. Now, I know that the appreciation of value and depreciation of values of a home is something to think about. So,
Yeah.
but today it's relatively understandable. Then how do we think about creating programs that create the reserves that we were talking about?
Yeah, especially in those first 5 years. David, how's Guild thinking about this?
Very similar. I think what Eileen just said, historically, when you think about down payment and why it's important, you hear the word skin in the game. And the thought is the psychological connection that you have money invested in the property will keep a person to stay in that home when things get tough and they're thinking about, should I fight for the home and stay here or just walk away? And I would argue that if you have a 3% down borrower and you get in trouble the next month, just the transaction costs alone would wipe out your equity. So, that 3% equity, I don't think is going to really be by itself a magnet to keep a person in the home. And if they're in this math problem of, lower reserves, if you take that 3% down, put that as a cash reserve instead, the other argument is, well, the borrower will just go to Hawaii on vacation and spend it that way. Well, they could, maybe some will, but many won't. And at least if it goes into down, they don't have a chance to have that cash, period. If you let them have that cash, you put them in a better position, they have more of a buffer, and I think that's a better chance to help a person get through. And I think a person's creditworthiness has a strong correlation to their income. If someone has a really good FICO score, is that because they just have really good character? Or is it because maybe they had a lot of wealth and a lot of income, and they were able to pay their bills, and they're never in a situation where they just didn't have the funds to pay? There's a lot of first-time home buyers who have good character, and if they pay a bill late or not at all, it's not because they just don't care, or they don't care about their promises. They don't literally have the income or the asset cushion to tap into. So I think the idea of down payment we should relook at and look at the VA model as an example of a zero-down program that has very good performance numbers.
Yeah, and I would just add to this conversation about down payment assistance, we want to make sure that there is a level playing field with all of the mortgage companies that have different programs. So if there are lenders that are affiliated with home builders, they should be able to offer similar programs that lenders who are just IMBs can offer. I think that's very important. And also, I think that when we're talking about down payment assistance, we have to make sure that the borrower isn't having to pay for it in another way with premium pricing, because that's something that we saw in the lead up to the crisis, and it led to many, many problems for borrowers. So we want to make sure that whatever down payment assistance is provided, whatever gifts are provided, that it's truly assistance, that the borrower is not paying for it with, a higher note rate.
Yeah, that's right. It's a really good point. So, Giselle, we've talked about down payment and reserves, and especially this increased conversation around reserves. What about monthly payment level?
Yeah.
And how important is that in the sort of equation of a borrower's sustainability?
Yeah, well, this is something where it's coming to light in a major way right now with all of the conversations that we're having about rising insurance costs. And then similarly, in different parts of the country that have experienced rapid gentrification, as well as an influx of COVID migrants, they've seen increases in their property taxes. And in the COVID pandemic mortgage program relief, one of the programs that I had the opportunity of working with several states on setting up their programs was the Homeowners Assistance Fund, which provided assistance for a number of different housing expenses, not just the mortgage expense. And I think that this is one of the challenges. If you are a lender, you're going to have to advance those taxes and insurance. And if you're a borrower and you miss your insurance payment, and stop paying, you could have your lender put a forced place policy on you, which very quickly could become, unaffordable. And so this is one of those issues where I think borrower education is going to be very key, but it's an issue where at the federal policymaking space, our hands are very limited. Insurance is regulated at the state level. Insurance premium increases. If states try to put caps on premium increases, then, sometimes those insurers will decide, okay, we're not going to write any new policies in this state. And then similarly with property taxes, local property taxes, it can be very challenging to provide any relief to those homeowners who are experiencing challenges in meeting their property tax obligations, particularly from the federal government. We were really lucky with the HAF program that we had legislation that authorized for states to provide funds for homeowners who were experiencing challenges meeting their property tax obligations during COVID. But I'm telling you now, if there's another crisis, I very much doubt that there will be a massive relief program available for these associated housing expenses. So borrower education is going to be key to let them know.
Yeah, definitely. And Eileen, we've talked about borrower education, and I know that's something that you're really focused on at Rocket. And I think something that we saw kind of come out of the response to the pandemic, a tremendous amount more communication, I think, than maybe we saw in the wake of the financial crisis. Can you talk a little bit about your approach to borrower outreach education, both on the front end and on the sort of servicing side, should borrowers get into trouble? How are you thinking about that with your team?
Giselle, you hit it right on the nail on the head right there, which is education. We learned, especially during the pandemic, how important it was to educate borrowers that what the loss mitt programs are. What we found is people didn't know the difference between a forbearance, or they didn't know the difference between like a modification. And what we had to do was explain, like, this is the path you would go towards in order to be able to stay in your homes. And so kind of making those terms very simple was very key. And so not only was it education, it was also communication and quick and often. So what's good is you can understand how borrowers' payment habits are as you're servicing them. And so if you reach out to them even before they hit the 30-day mark, if they've been 30 days or slow pay, we can understand that pattern, and we can reach out and say, can we offer any help? Is there anything that we can do? It really breaks down the barrier, and it helps borrowers feel like I have a servicer I can trust.
Yeah.
To have these conversations, because it's very difficult. When people are going through some difficulties, they don't want to share it all, right? And so the third thing that we learned was providing tools 24/7. And so within our servicing platform, offering up educational tools that they can access and understand their programs any time of the day is helpful. Again, they might not want to share what's going on quite yet, but I need to understand what my next steps could be. Providing those that are easily accessible every day, like I said, really makes a huge difference.
Yeah, digitally too, I would imagine.
Yes,
We
that's
just
right.
heard in the prior panel, or one of the prior panels, another lender talk about, I think he said some 70-some percent.
97%.
Yes. That's
They
right.
actually, right, I think it was B of A, I think it
Is
said
that right?
that.
Yeah, that's right.
We're searching on programs digitally, and I think it's the same as far as being, imagine if it's your own loan, that's probably the first thing you want to do is do a little bit research first.
Yeah.
And so if you can get those tools and education up in front of them easily, it makes a huge difference.
Yeah, and you talked a little bit about the relationship, building the trust, which I have a background with Habitat for Humanity. I actually just went to a dedication this morning. It was pretty amazing, right in my own backyard in Tacoma Park. one of the things I think that they do a really good job of is building that relationship with the homeowner from the very beginning. Habitat has extremely low default rates, and I think there's a reason for that. That trust is built from the very beginning, so those borrowers feel comfortable reaching out, so they've built that relationship, and it sounds like that's something that Rocket's really prioritized. David, what about at Guild? How are you thinking about sort of education and borrower outreach as part of that puzzle piece with sustainable homeownership?
I really echo the comments you both just made. Trust is key. You can build the trust through having a very high quality origination experience, and then in Guild's case, we retain the loans that we originate, and so that you continue that experience. So it's not uncommon if a borrower has a question about their escrow account, they may reach out and call their Guild loan officer who did their first loan, and actually the loan officer likes to take the call because they can check into it, solve the problem, answer the question, and that keeps them connected to the borrower. If they give them good service, they might get future referrals, and so it creates a sense that you aren't just a number calling an 800 number, that you're a human, they know you by name, and if you have that high level of trust, the key is when a borrower gets into trouble, you want them to let you know as soon as possible. There's a lot of connection between this. The sooner a borrower contacts their servicer, the better chance you can find a solution that might be more optimal than if they wait too late.
Right. So thinking about that, thinking about what Giselle just sort of mentioned, that another homeowner assistance fund, for some future crisis, whatever it may be, may not come down the pike. So what can we focus on now, things that are working well that we can continue to enhance to make sure we are even more prepared for any kind of future? And I will say too, I think the industry's response in the wake of the pandemic was pretty tremendous. And I think we at Freddie Mac, we were sort of bracing ourselves at the beginning to say, oh my gosh, are we going to see the wave of constituent cases and other things that may come in like we did in the wake of the financial crisis, and we did not. I mean, I think that's a testament to the tremendous amount of work that the industry had done sort of since the financial crisis to now to really shore up that sort of servicing side and likely too on the credit policy side, right? Like looking very closely at that. So if you guys had to give advice to servicers, to borrowers about what we should be doing more of or maybe even doing a little less of in terms of what we could do to continue to strengthen that sustainable piece and be prepared for whatever may come our way down the pike. And I will say, Eileen, let's jump in.
I think one thing to think about when we think about sustainability and servicing programs is to ensure that there's savings when it comes to, when I say savings, I mean savings in the payment, monthly payment, a payment reduction. We talk about payment relief, right? And so there is reasons why they can't make their payment, and so whatever program is stood up, it should contemplate that. So FHFA is considering the payment supplement program with that idea in mind. And so I think ensuring that happens and not falling into the pitfall of creating programs where an interest rate reduction doesn't work anymore, because guess what? Interest rates are actually higher than what they probably currently have. So putting them in a higher interest rate really won't work. So that strategy has to be thought of quickly, of how to pivot to be able to help people into their mortgages.
That sounds right.
Yeah.
David?
I think if you look at what happened during the COVID recession and compare that to 2008, it was a night and day difference. In 2008, if you were a borrower in trouble, you had a really difficult time getting a hold of your servicer. They asked for a lot of documentation. It took them a long time to run through it. There's this crazy NPV test that nobody understood. And then maybe 6 months later, you get 10% reduction in your monthly payment. Well, you lost your job. A 10% monthly payment lowered did not solve anything, and so you lost the house to foreclosure. Plus, in 2008, lots of people stripped out equity in the preceding years through lots of repeat refinances. There's 125 second LTVs and 100 cash out refi firsts out there in the market. So it was a very different market. Compare that to the COVID recession, where if you just called up your servicer and said, hey, I was watching the news last night, and they mentioned this thing called forbearance. What is that? You immediately got put into forbearance. Even if you didn't need it, even if you still had your job, you were in forbearance. And so I think for the next recession, the answer will be somewhere in the middle of the two. And for some scenarios, forbearance might make sense, but I agree it won't be across the board. I mean, it is expensive. There's a cost to do it. It's expensive for servicers. It impacts bondholders. It has a lot of impact. But for someone who lost a job, that could be one option, but maybe more temporary on a shorter term basis. Note modifications, those work well if the note rate you're modifying happens to be above current market. You could do that. That may not be the case in the next recession, or maybe fewer people that might fit that. So I think it'll come down to more tailored solutions that fit each unique person. I don't think, at least I hope not, we don't just give forbearance to people who don't even need it, who didn't really even ask for it. And I hope there's some minimal amount of documentation just to make sure a person really did lose their job and they're not just getting free forbearance at a time when their income is uninterrupted.
Yeah.
So hopefully it's more of a balanced, custom-tailored response compared to the
Yeah.
COVID
Okay.
strategy.
Yeah.
And I would echo Eileen and David. I think that when we look at the response to 2008 and very high documentation requirements for borrowers to get assistance, those programs did not help very many people. And so we need to balance to make sure that there's not a moral hazard, to make sure that borrowers really do have a financial hardship. However, I think one of the successes of the HAF programs that I worked with is they required borrower attestation of financial hardship. And if they, did not actually face a financial hardship, they could be facing some serious criminal penalties. So I think that having borrowers attest to financial hardship if they are in it in order to receive either a forbearance or other assistance is going to be key. But I think having overly prescriptive programs, overly prescriptive borrower documentation requirements, that is going to both prolong a already bad situation, and it's going to be counterproductive to actually helping keep borrowers in their homes.
Yeah. That was a really, really great insight. So I'll ask one more question and then we can open it up to the audience. How should we be measuring success in the sort of housing sustainability space, thinking about borrowers staying in their homes? What things do we need to take away from this conversation and continue discussing with our industry partners to strengthen housing sustainability for the future in the lens of like what success looks like? And Giselle, we'll start with you and go down.
Yeah, so the Federal Reserve Bank of New York has actually done some really great research here, and they've, kind of called out the government for not having a good borrower homeownership sustainability metric for our primary program for first-time homebuyers, which is the Federal Housing Administration. And I think that, as I said before, I think that all of our private and public sector programs to support homeownership need to be linked with homeownership sustainability. And as we're thinking about what constitutes success, again, it's complicated. Some people would say that homeownership has not been sustained if a borrower ends up selling their home and renting. I may have disagreements with that definition, but I think that, again, at a very minimum, sustainable homeownership means that a borrower does not experience a foreclosure event. That being said, I think that as we're thinking about foreclosures, we do need to recognize that distressed properties are a source of homeownership opportunity, and that it doesn't have to be a zero-sum game, that we can have a graceful exit for borrowers that are experiencing financial difficulty that does not result in a foreclosure. You can have cash for keys programs, and cash for keys programs need to be done in such a way that there are a recognition that this is truly a cheaper alternative to foreclosure, and provide some financial incentives for borrowers to pursue that option if they truly cannot maintain homeownership. And again, a recognition that unfortunately not all foreclosures are preventable, I think is also going to be important as we're, having these conversations about sustainable homeownership. And that, as we're trying to provide as many opportunities for borrowers to stay in their homes, also we need to recognize that there does come a certain point where this home is no longer sustainable for this borrower. So how do we make sure that that borrower continues to have access to housing?
Yeah, has a graceful exit and then an opportunity, something that makes sense for them on the other side of that. That makes a lot of sense. David, what about you?
I think how we should define it is expanding the people we serve, addressing the underserved markets, specifically closing the minority homeownership gaps, but doing it in a way where it's not like the pre-2008, like Director Thompson described, but expand homeownership opportunities without putting people in loans where they don't have the ability to repay. In order to do that, I think we cannot use today's existing tools and think we'll get different results using the same tools. And what I hope as an industry that DTI, as we know it today, is a small or zero part of our future credit underwriting, and that we look at residual income as a much better way to measure a person. If you look at a person today, you can have two identical people with exact same DTI, and they could be in very different financial positions. One could be in a high tax state, one could be in a low tax state. One could have their health care paid by their employer, the other could be paying it out of pocket. One could live in a home with very different expenses. Maybe one has high energy efficient appliances and one doesn't. Maybe one has monthly obligations that don't show up in their credit report. Maybe they make their mother's car payment every month. It doesn't show up in the credit report, but it's a bill they pay every month. With electronic bank data, as Eileen was describing, you can see their actual real take-home pay each month, and you can see their actual real total expenses each month. And Guild, in our servicing portfolio, we looked at 3,000 first-time homebuyer loans we did, and we looked at that data where we had at least 12 months of trended data. And the borrowers who had 12 months of positive residual income, meaning their take-home pay was above their total expenses each month, they had a loan default performance ratio equal to a credit report, to a good credit score. So if you were above a ratio of 100%, you performed like a 720 FICO borrower.
Yeah.
And so I think by having tools like this that allow us to, in my opinion, more precisely better measure credit risk, we can expand credit because there's, per the Urban Institute, 65% of black adults are below a 620 FICO. If that's the barrier to entry into the GSE products and also in the risk-based pricing grids, that's the bottom of the pricing grid, how is that not a barrier? And whether it's Asian home buyers, whether it's black, Hispanic, or any other underserved community, many of the underserved communities don't have traditional credit histories to the same extent that white borrowers do. And so if you look at bank data, there are people like my father who was a small business owner and he had one credit card. So his FICO is terrible, but he never paid a bill late ever in his life. And so I think through better means and better measures, we can expand credit and still help sustain people in their home and make sure they're into a very thoughtful mortgage where they can pay. And it's not some extrapolation. It's like, yes, here's their income, here's their bills, they have enough to pay it. And you can be confident.
That makes a lot of sense. Eileen, what about you?
I mean, both of you pretty much said it, so I'm not going to repeat a lot of that. But I totally agree about the idea of expanding credit and credit worthiness. And if you think about the term invisible credit, that just, how do we address that, right? Our models today are that you have to have certain data points. And we've proven just in this conversation alone that not everybody has that. And so how do we find those that should have a home, can afford a home? How do we create programs around that? How can we see that? And we have to think about things differently. And then as far as sustainability, it's just ensuring that the programs address the needs of the borrower. And if they are unable to stay in the home, then it's not to say they have to have a home. Maybe their best solution is something else, maybe a more affordable rent if it's out there. And so how do you show compassion and how do you show dignity to borrowers to say, it's okay and let me help you. And so I think that to me would be providing shelter in whichever way you can, and doing it in the right way.
That's right. So I'm hearing borrower needs first and foremost, residual income, bank statement, basically new and different data points that we need to think about. Reserves are as important as down payment, and to make sure that sustainability is there, and education, communication, and trust. So these are the things I keep hearing over and over again. So why don't we take questions from the audience? We've got about 10-ish minutes. Let's see, we've got someone with a microphone. Perfect.
Hi, my name's Nicole. I'm an economist with Zillow. I want to kind of go back to talking about the increasing costs of property taxes and insurance as being something that threatens the maintenance of homeownership for a lot of populations. Especially, earlier today there was a panel in here talking about the impact of API homeowners who have higher housing burdens. So you're spending already a higher share of your income on housing, and then you see these increased costs on top of that. Are there any sort of programs or ways that we can access kind of creative financing, maybe tapping into home equity or something like that, as a means to pay for these increasing costs without having these homeowners have to go through a refinance, since refinancing is often expensive and not always attainable by a lot of households in different financial situations? Or are there any products that you all have heard of or thought about that might be able to help solve this problem as we continue to see these costs rise?
There are various second lien programs out there where a borrower could tap into their equity through a fixed rate or variable rate, or even an equity share second lien. And so that might be a temporary solution, but I would suggest that if we can find a way just to limit the rise in cost to be more in line with actual real expenses on the insurance side. In my opinion, the increase has gone faster than the actual losses has, and part of that is just a kind of a boom bust cycle in the industry in terms of, if you're insured in any market and 5 of your competitors just backed out, you're going to raise your prices tomorrow regardless of risks have gone up at all. And so I think that we can smooth some of that out, and whether it's a federal backstop, anything that can help diversify the insurers, allow reinsurance risk to come in, so that if you're an insurer and half of your competition just left your market, that you can still do business and pick up the business that they dropped. That'll be the best case to keep costs low. But I think this is a serious issue that it seems to me the industry is just becoming aware of in terms of the scope and impact. And if we don't find some way to address it, this is going to be a serious, in terms of sustainability, this is going to be an impact on people, and there'll be borrowers who literally going to be priced out of their homes due to this cost. And those would be typically retired or fixed income borrowers.
Yeah, and for the tax issue, I mean, this is a challenge where it really is a double-edged sword, particularly for a lot of borrowers who are coming from minority communities that have been gentrified, where they're seeing, okay, property values are going up. That is absolutely wonderful. What comes with increased property values? Increased tax burden. And again, there are no really easy answers there. And as I said before, I doubt that there's going to be a massive $10 billion, $20 billion program to essentially bail out homeowners if we see a major recession in the next couple of years. And so I think what's going to be important is, one, that policymakers are cognizant of the fact that it's not just mortgage expense that's going to be driving the next foreclosure crisis. If you're someone that if you're a first-time home buyer, I mean, most of the FHA first-time home buyers that are in the portfolio now were originated in the past 3 to 5 years. So they probably have a affordable mortgage payment, but if they're in Florida, if they're in Texas, even in Georgia, it's really all over the country that you're seeing these increases in insurance premiums. And at a federal level, as I said, very little can be done. And the local property tax burden is also an issue that is driving unaffordability for a number of different communities. So I think what's going to just be important is for all of the policymakers who are working in the housing and mortgage space to be cognizant of the typical things that drive foreclosure in the past, that's not what could be driving it in the future.
That's right.
Thank you. My name is Michelle. I'm from Detroit, Michigan, and it's for Rocket Mortgage. You may or may not be able to answer it. So a few years ago, they came up with something to help pay back taxes for folks in homes. Well, they didn't do any education, they just paid the taxes. So 3 years now, we have those same folks that are back in the same position, and I don't know what to tell them. I don't know if they can go back. I haven't viewed any of the documents that they've signed, but I know we have a lot of homeowners in the same area. They receive some help with the taxes, but now some of them are right back where we started 3 years ago. So, like, why wasn't some type of education done with that? Some type of data to watch them maybe for a year? Because if the house is foreclosed on, then it just leaves a hole in the community again. And we have a number of them in my area, in Detroit.
I think you just hit it really well, and we've been talking about that for quite a while, like throughout. Education is so important, and it's not even just one time. You could argue maybe there was a disclosure, but how easily is it that we as humans forget things, right? We just have to repeat, and that's just fantastic feedback to say that needs to keep going. The idea of being able to pay the tax burden and therefore stay in the home, I think, is fantastic. So that was great. How do you keep it going? So I think those are great comments, and those are things that programs that are offered. We got to keep the education going. That's a very, very solid point.
Yeah, thank you for that question.
Hi, I'm Hei Pinin with Faith and Community Empowerment, informative panel. First, I just want clarification on what you said earlier. So does that tool already exist that you are looking at in terms of people's actual available, I guess you're calling residual income? So could you clarify that? And also that you said that you looked at, and if they had, was it 1 month's reserve, 1 year reserve, or twice the payment? Could you clarify that first? I have more questions, so. Yeah.
Yes, the tool we use is through FormFree, and they're one of the vendors that provides the digital bank account reports. And so on their report, if you had 12 months of data, in terms of 12 months of income data, 12 months of expense data, if you look at the 12-month trend and you saw a positive number for 12 months, that was considered to be a good report. So we looked at borrowers who had 12 months of data, and we looked to see how they performed over a 6-year time period. And we found that borrowers who had positive residual income, meaning their income was at least equal to their expenses, that those borrowers performed, and we looked at them by different bands of how much above they were, and they performed like a high credit score borrower, 720 and above. And the borrowers that were below performed, like 680s and 640 credit score borrowers. So there was a very strong correlation. Credit scores and residual income measure two different things. It's not that one's better than the other. I think this gives us two ways to look at it. I think we should have like a three-legged stool, how we look at people. Look at their credit history, which is their history of credit accounts. Look at their non-credit account history, which would be like rent and utilities. And then residual income is sort of the third leg of the stool, and that's their current position. It's not just DTI measured one point in time the day before the loan closed, it's the last 12-month running. I think those three give us more of a complete picture of a person's financial position and their capacity to repay.
So I'd like to just agree with you. And I don't know where the industry is in terms of using those tools, because I want to emphasize about the need for education/housing counseling, because, like, for example, we are a partner for Bank of America's Special Purpose Credit Program. And the loan officer will say, you're ready, but they still need the certificate, right? So they send the client to us, and we're looking, and actually they're not supposed to, but some were already in escrow when we came in. And when we look, because of, it's not just their debt to income ratio, right? But all the other expenses that are not reflected, this client would not have been able to sustain. And I'm just wondering, shouldn't the whole industry use those tools to really properly assess? And so I just want to put that out there. Second,
And HeyPen, Freddie Mac is doing, I mean, that three-legged stool, we're also looking at rental payment history, bank statement data with borrower's permission. This is, I think, where the industry is headed for sure.
that's awesome news, right? I think another piece is around outreach. Again, I know that during the last foreclosure crisis, some people came in at, when they finally heard, and by that time they had cashed out all their credit cards, they used up all their family, relative, whatever resources. And so I want to also put that out there and just plant seeds or advocate for more of outreach to all communities as well. One last piece. Someone mentioned earlier about like equity, right, as looking at as an option. I remember, again, the last foreclosure crisis, someone came up with the idea of, well, why don't you just reduce their debt? And the lending institutions thought, that idea was crazy, but ultimately that did happen. And so, again, I don't necessarily have all the answers, but again, thinking out of the box of what are some creative solutions that don't exist today that could be helpful as well. So that's it. Thank you.
Thank you. Brittany, do we have more time? I see triple zeros over here. Okay, great. We got one more question.
Hi, Daniel Smith, Keepingly. One of the things that I don't think I heard mentioned too much is about the maintenance cost. Maintenance is a pretty big cost as a society. We are doing approximately between 30 and 60 billion per year in emergency repair costs. That impacts homeowners tremendously during the life cycle, in addition to all these other things, insurance, taxes, etc. I live in Florida. One of the things, I've seen my insurance rate just increase near $3,000 from last year to this year. How do I build in for that? And so ultimately, I think that sustainability question, we need to start looking at solutions. My company, we are building a solution focused on home ownership sustainability. But I think that as an industry, we need to be looking at, especially for minorities, first times, all these disadvantaged groups who don't have the tools. Because as you've rightly said, education is the critical key. How do I know when to refi? How do I know what to look for, even think about? And so I think that we have to look at solutions, and some of them that you kind of mentioned, but I think that there are more, and we have to start looking at them really comprehensively.
Yeah, and I would just say that, going back to my original point that sustainability starts with the original mortgage, one of the policy changes that FHA has been working on in this current administration is changes to the 203K rehab loan program, which allows a borrower to purchase a home and then make repairs. And I think this is particularly impactful for minority borrowers that are buying existing homes in, perhaps an up-and-coming area. And so if you have a loan that, again, is going to allow you to make those repairs, that's one way to kind of deal with some of these ongoing cost issues.
That's right. Go ahead.
I know we're over time, but
Jump in
here. As an industry, here's what we could do, because to Giselle's point, minority home buyers are more likely, per Harvard, to buy older homes that have older appliances and have higher maintenance costs and more likelihood of repair and replacement costs. So what if, for first-time home buyers at certain income thresholds on the low-income side, if we put in a new hot water heater and a new refrigerator in every first-time home buyer's home? Gives them a monthly payment savings to more energy-efficient appliances, and it takes away 2 of these curveballs off the table during those first critical 5 years. And I would say that's a very good way to invest in people, invest in their new homes. we could take that one step further and maybe do $5,000 or $6,000 of energy efficient appliance upgrades, which would be almost a mini version of like the FHA program as a rehab, where it's not a major rehab. These are all like one-day installs, appliances, like core critical appliances that a household functions on. But if they're new Energy Start, energy efficient appliances, it's good for climate change. It lowers their monthly payment, so it's good for the residual income and their ability to accumulate savings. And if you have 5 new appliances in your house on day one, every one has at least a 5-year warranty, and you'll get through that 5-year critical time period without having any one of those 5 appliances just blow up on you. So by doing that, we can hit several goods. And I would argue the GSE energy efficient products we have today are probably 20 plus 30 years old. And they do fit these, but we could find ways to update those products to make them more efficient and tap into this bank data, because the bank data does give you utility bill history, which is a very powerful tool to measure if a program worked or didn't work, because you can look at before and after.
Yeah.
Sorry for
No,
jumping
that's
in.
great. I think it's a good place for us to wrap up. Let's thank our amazing panel. Thank you guys so much. Appreciate the great questions.